There is a single fatal mistake that separates the amateur investor from the professional. It's a silent portfolio killer, a subtle error in judgment that can turn a brilliant business analysis into a decade of financial disappointment. It's the reason why you can be right about a company, its innovation, its market dominance, its visionary CEO, and still lose money. This mistake isn't about picking the wrong company. It's about succumbing to the most seductive lie in the entire market, that a great company is a great investment at any price. This is a fallacy that has vaporized more wealth, crushed more dreams of financial freedom, and caused more sleepless nights than any market crash in history. Warren Buffett, the most successful investor of all time, has built a multi-hundred-billion-dollar empire on the foundation of one single inviolable principle, a rule so powerful it acts as a permanent shield against this costly error. The principle is this: the price you pay determines your rate of return. It is not the quality of the business alone, nor the brilliance of its management, nor the excitement of its industry that guarantees your success. It is the discipline to buy that quality, that brilliance, that excitement, for less than it is truly worth. Overpaying for a wonderful company doesn't just reduce your returns. It can transform a masterpiece of commerce into a terrible, wealth-destroying stock. Mastering this one concept is the final promise of investing. It is the key that unlocks the door between speculating and investing, between chasing market sentiment and building generational wealth. It will teach you to stop falling in love with a story and start demanding a bargain. By the end of our time together, you will possess a mental framework that will ensure you never, ever overpay for a stock again. This isn't about complex formulas or arcane financial jargon. This is about installing a new operating system for your financial mind, a CEO mindset that prioritizes value above all else, ensuring that every asset allocation decision you make is rooted in the unshakable foundation of buying wonderful companies at fair prices, the true path to lasting portfolio growth, and the ultimate defense in a volatile market. Our journey into this transformative principle begins not in a frenetic Wall Street trading room, but in the quiet, sun-drenched landscape of California in the early 1970s. This is where we uncover our first pillar, the parable of the overpriced masterpiece. It's a story about a box of chocolates, a stubborn family, and a decision that would forever change the course of investing history. It is the story of See's Candies. In 1972, Warren Buffett and his partner, Charlie Munger, were presented with an opportunity. The See family, descendants of Mary See, who had founded the eponymous candy company in 1921, were looking to sell. Buffett and Munger, through their holding company Berkshire Hathaway, took a look, and what they saw, they loved. This was not some speculative tech company or a complex industrial conglomerate. It was a simple, beautiful business. See's Candies had a brand that was nothing short of iconic on the West Coast. Generations of families associated See's with holidays, celebrations, and quality. This wasn't just candy, it was a tradition. This deep-seated brand loyalty gave the company tremendous pricing power. They could raise the price of a box of chocolates year after year, and customers wouldn't just accept it, they would happily pay it, because the emotional connection to the product transcended the price tag. The business required very little capital to operate. It didn't need massive, expensive factories or constant research and development. It sold chocolates, took the cash, and could use that cash to open new stores, or, more importantly, send it back to its owners. It was a cash-generating machine. Buffett and Munger saw a business with a durable competitive advantage, what they would later call a whoot. They saw a wonderful business. The problem, as it so often is, was the price. The See family, represented by the then-president Harry See, was asking for $30 million. Buffett, ever the disciplined analyst, ran the numbers. At the time, See's had about $7 million in tangible assets, things like stores, inventory, and equipment. They were earning about $2 million a year after taxes. Paying $30 million for a business earning $2 million was a price-to-earnings ratio of 15. For Buffett, a disciple of Benjamin Graham who was trained to buy companies for less than the value of their tangible assets, this was a steep price. His mind, conditioned for decades to find statistically cheap cigar-butt investments, recoiled. He calculated what he thought the business was worth and made an offer: $25 million. Harry C. was unequivocal. The price was $30 million. No negotiation. Take it or leave it. For Buffett, the decision seemed clear. It was too expensive. It violated the principles he had practiced his entire life. He was ready to walk away. This is the critical moment in the story. This is where the amateur investor, swept up in the romance of owning a fantastic business, would have capitulated immediately. But Buffett's discipline held. He was willing to let a wonderful company go because the price was not right. But then, something crucial happened. His partner Charlie Munger intervened. Munger, who had a slightly different perspective, argued passionately that Buffett was making a mistake. He told Buffett, in essence, "You're thinking about this the wrong way. We are not just buying $2 million in earnings. We are buying a business that can grow its earnings for decades without needing any more capital. We are buying a brand that is almost irreplaceable. A business of this quality is worth paying up for. If we don't buy this, we are going to regret it." The debate was intense. Buffett, the numbers-driven pragmatist, versus Munger, the philosopher of quality. Finally, reluctantly, Buffett agreed. They would pay the $30 million. He later confessed that he did so with a churning stomach, feeling he had grossly overpaid. He thought he had violated his own cardinal rule. But what happened next became the foundational lesson of his career. See's Candies, the business he almost let slip away for $5 million, would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all without requiring significant additional capital investment. It became the prototype for the kind of business Buffett would seek for the next 50 years. The lesson, however, was not buy great companies at any price. That is the dangerous, superficial interpretation. The true lesson was far more nuanced and powerful. It taught Buffett that the concept of value had to evolve. Value wasn't just about tangible assets on a balance sheet. The intangible value of a powerful brand, of customer loyalty, of pricing power. These were real economic assets, and they had to be factored into a valuation. But it also reinforced his core belief in a new way. Even with a business as spectacular as See's, there was a limit. What if the C family had asked for $100 million or $200 million? At some point, the price would have been so high that even the company's wonderful economics couldn't have provided a decent return. The See's Candies story is the perfect parable because it illustrates the razor's edge on which every great investment decision rests. It is the tension between the quality of the business and the price you are asked to pay. Buffett learned he had been undervaluing quality, but he never abandoned the principle that price is the ultimate arbiter of your success. He simply expanded his definition of value to include the durable, long-term earning power of a truly exceptional enterprise. And in doing so, he almost made the mistake of being too rigid. But he also came perilously close to the mistake that sinks 99% of investors, letting the beauty of the business blind him to the mathematics of the purchase. The final price of $30 million was, in hindsight, a bargain. But it was a price that was, at the time, at the absolute upper limit of what a disciplined investor could justify. It was a lesson in paying a fair price for a wonderful company, not a foolish price. The internal struggle Warren Buffett felt during the See's Candies negotiation reveals a powerful psychological current that runs beneath the surface of all financial markets. The reason why the mantra "a great company is a great investment at any price" is so dangerous is because it preys on several deep-seated cognitive biases. The primary culprit here is what psychologists call the anchoring bias. This is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In the stock market, the anchor is often the company's narrative. We hear that a company is innovative, that it's the next big thing, that it has a visionary leader. This powerful story becomes our anchor. We become so attached to the idea of the company's greatness that our perception of what constitutes a fair price becomes skewed. All subsequent information, including a soaring stock price, is filtered through this initial positive anchor. We stop asking, what is this business worth, and start asking, how can I justify paying this price to own this amazing company? The dialogue shifts from objective valuation to emotional rationalization. Buffett's initial training was anchored in Ben Graham's deep value principles, buying assets for pennies on the dollar. The See's Candy story was his moment of de-anchoring. Munger forced him to lift his anchor from the seafloor of tangible assets and consider the intangible anchor of brand quality. But for most investors, the anchor is simply the popular opinion, the ticker tape, the headline. They anchor to the narrative of success, and this makes them vulnerable to paying any price to be a part of it. Closely related to this is a phenomenon known as the winner's curse. In auction theory, the winner's curse describes the common outcome where the winning bid in an auction exceeds the intrinsic value of the item purchased. The winner gets the prize but has overpaid to get it. The stock market is, in many ways, a giant continuous auction. Every day, buyers and sellers are shouting prices at each other. When a stock becomes a must-own darling, a bidding war ensues. Investors, driven by the fear of missing out, get caught up in the excitement of the auction. The goal shifts from making a profitable investment to simply winning the stock, getting an allocation in the hot IPO, buying before it goes to the moon. The emotional thrill of participation and the social proof of seeing everyone else bidding drives the price higher and higher, far beyond any rational assessment of value. The person who finally buys at the peak is the winner of the auction, but they are cursed with a starting price from which it is almost impossible to earn a satisfactory return for years, sometimes decades. Buffett's reluctance to pay $30 million for See's was his internal defense against the winner's curse. He was willing to lose the auction to protect his capital and his future returns. The amateur investor, on the other hand, fears losing the auction more than they fear overpaying. This is a fatal psychological flaw. They equate the rising price with validation of the company's greatness, when in reality, the higher the price goes, the riskier, not safer, the investment becomes. The rate of return you can expect from an asset is inversely proportional to the price you pay for it. A higher price, by definition, means a lower future return, all else being equal. The winner's curse ensures that in the heat of a bull market, the most enthusiastic winners are setting themselves up for the biggest future losses. These biases are not signs of low intelligence. They are features of the human brain. Our minds are wired for storytelling, for social conformity, and for quick, intuitive judgments. We are not naturally equipped to be rational, detached valuation machines. That is why the discipline Buffett demonstrates is so rare and so valuable. He has trained his mind to override these default settings, to consciously separate the compelling story of a business from the cold, hard math of its price. He understands that the market is a psychological battlefield, and the first enemy to conquer is the one inside your own head. So how do we translate this high-level understanding into a practical tool? How do we build a defense system against our own psychological flaws? The answer lies in adopting an applied mental model, a blueprint for decision-making that forces discipline and objectivity. We call it the price is what you pay, value is what you get framework. It's a simple, three-step process that you can apply to any potential investment, from a blue-chip stock to a piece of real estate, to ensure you never fall into the trap of overpaying. The first step, and perhaps the most important, is to rigorously separate the business from the stock. Before you even look at a stock chart, before you look at the 52-week high or low, you must become a business analyst, not a stock market commentator. This means diving into the company's annual reports, its 10-kilo-second. Your goal is to understand the business as if you were going to buy the entire company outright, not just a few shares. Ask yourself a series of fundamental questions. How does this company make money? What is its core product or service? Who are its customers? More importantly, what protects this business from competition? Does it have a powerful brand like See's Candies or Coca-Cola? Does it have a network effect, where the service becomes more valuable as more people use it, like Facebook or Visa? Does it have a low-cost advantage, like Costco or Geico? Is it protected by patents or regulatory licenses? This is the search for the economic moat. A great business has a wide, sustainable moat that protects its profits from invaders. You must be able to describe this moat in simple, clear language. If you can't, you don't understand the business well enough to invest. During this phase, you are completely price agnostic. You are making a judgment on business quality alone. Is this a wonderful business, a good business, or a mediocre business? This initial step prevents you from falling in love with a rising stock price and forces you to fall in love with a durable business model. The second step is to establish your walkaway price. Now that you have a firm grasp on the quality of the business, you must calculate what it is worth to you. This is the art and science of valuation. While there are complex methods like discounted cash flow analysis, the core concept is simple. A business is worth the sum of all the cash it can be expected to generate from now until it closes its doors, discounted back to what that cash is worth today. For a more practical approach, you can use metrics like owner earnings, a concept Buffett himself popularized. Look at the company's net income, add back depreciation and amortization, and then subtract the average amount of capital expenditures the business needs to maintain its competitive position. This gives you a rough idea of the true cash flow available to owners. Once you have a conservative estimate of this annual owner earning power, you must decide what rate of return you require on your investment. If you demand a 10% return, you would take the owner earnings per share and divide it by 0.10. That number is your absolute maximum walkaway price. For example, if a company consistently generates $5 per share in owner earnings and you require a 10% return, you would not pay a penny more than $50 per share. This process is critical because you are setting your price tag time before times you go shopping. You are defining value on your own terms based on the business's economics, not on the market's manic mood swings. This walkaway price becomes your anchor, a rational boundary that protects you from emotional decisions. The third and final step is to compare and act, with patience as your guiding virtue. Now and only now do you look at the stock market. You compare the current market price to your predetermined walkaway price. In most cases, especially with wonderful companies, the market price will be significantly higher than your valuation. This is where 99% of people fail. They fudge their numbers, they increase their growth assumptions, they tell themselves, "This time is different," to justify paying the market's price. Your job is to do the opposite. Your job is to do nothing. Your default action is inaction. You place the company on a watch list, and you wait. You wait for a market panic, an industry-wide sell-off, a temporary business hiccup, or a period of general pessimism that brings Mr. Market to his senses and offers you the business at your price, or preferably, even lower. This framework transforms investing from a game of chasing hot tips and reacting to news headlines into a disciplined, proactive process of business analysis and patient execution. You are no longer a passive price taker at the mercy of the market's whims. You become a professional capital allocator, a business owner in waiting. You know what you want, you know what it's worth, and you have the fortitude to wait until you are offered a price that provides not just the promise of owning a great business, but the mathematical certainty of a satisfactory return. This is the blueprint for building a portfolio of wonderful companies bought at fair prices, the absolute bedrock of long-term wealth management. To truly appreciate the wisdom of this disciplined approach, we must shine a bright light on its opposite. We must explore the antithesis, the path walked by the 99% of market participants who consistently underperform. This is the seductive and ultimately destructive path of growth at any price. There is no more vivid illustration of this folly than the dot-com bubble of the late 1990s. This was a period of mass delusion, a time when the old rules of valuation were declared obsolete, replaced by a new paradigm where eyeballs, clicks, and market share were more important than profits, cash flow, or any semblance of financial discipline. The story was intoxicating. The internet was changing the world, and any company with a .com in its name was seen as a ticket to infinite riches. Let's take a specific, powerful example: Cisco Systems. In the late 90s, Cisco was not a fly-by-night startup. It was a legitimately wonderful company. It built the routers, switches, and networking equipment that were, quite literally, the backbone of the internet. As internet usage exploded, Cisco's revenues and profits grew at a breathtaking pace. It had a dominant market position, brilliant engineering, and strong management. By every qualitative measure, it was a phenomenal business, a modern-day See's Candies on technological steroids. The market recognized this quality, and investors fell head over heels in love. The narrative was so powerful that it completely obliterated any concept of price discipline. The stock price became detached from reality. In March of 2000, at the peak of the bubble, Cisco's stock hit a high of over $80 per share. At that price, the company's market capitalization swelled to more than $550 billion, making it the most valuable company in the world. Think about that for a moment. The market was saying that this company, which sold networking equipment, was worth more than giants like General Electric or ExxonMobil, companies with decades of massive tangible profits and assets. At its peak, Cisco traded at a price-to-earnings ratio of over 200. Let's translate that. An investor buying at that price was willing to pay $200 for every $1 of the company's current annual profit. To justify such a price, you had to believe that Cisco's profits would grow at an astronomical rate for many, many years into the future, without any missteps, without any new competition, and without any economic downturns. It was a belief in perfection, priced for utopia. The 99% followed this path enthusiastically. They saw the stock going up every day and confused that momentum with a sound investment. They saw their neighbors getting rich and were consumed by the fear of missing out. They abandoned all logic and bought into the story. They paid the price. Then, reality reasserted itself. The bubble burst. The impossible growth rates failed to materialize. Competitors emerged. The economy slowed, and the stock began to fall, and fall, and fall. An investor who bought Cisco at its peak in March 2000 would have watched in horror as their investment lost over 85% of its value over the next 2 years. That is a catastrophic portfolio-destroying loss, but the tragedy is even deeper. Let's say that investor held on, believing in the quality of the company. Today, more than 2 decades later, Cisco is still a great, profitable company. It has generated tens of billions of dollars in profit. It remains a leader in its field. But the stock price? It has never again reached its year 2000 peak. The investor who paid the ultimate price for the ultimate growth story is still underwater, more than 20 years later. This is the brutal lesson of the growth at any price fallacy. The quality of the company was never in doubt. Cisco was and is a wonderful business. The problem was the price. The initial price paid was so astronomically high, so disconnected from the underlying economics, that it baked in years, even decades of future growth. By paying that price, the investor prepaid for all the good news and then some. There was no margin for error, no room for disappointment, and therefore no possibility of a decent return. The path of the 99% is paved with stories like this. They chase narratives, they buy hype, and they pay prices that make positive investment outcomes a mathematical impossibility. They mistake a great business for a great stock, forgetting that the bridge between the two is a rational and disciplined valuation. The wreckage of the dot-com bubble stands as a permanent monument to this folly, a stark reminder that even the most revolutionary technology and the most wonderful company can be a terrible, wealth-destroying investment if you forget the final promise: the price you pay determines your return. The connection between the price you pay for a stock and your financial outcome is not an abstract concept. It is a direct, quantifiable mathematical reality that manifests on balance sheets and in investment portfolios. Understanding this connection is the key to transforming your mindset from that of a speculator to that of a business owner. Let's strip it down to its simplest form. When you buy a share of stock, you are buying a proportional claim on the company's future earnings. The most straightforward way to measure the value you are getting at the moment of purchase is the, quote, earnings yield. This is simply the inverse of the more commonly cited price-to-earnings, or PE ratio. It's calculated by taking the company's annual earnings per share and dividing it by the price you paid for one share. For example, if a company earns $5 per share and its stock is trading at $100, its PE ratio is 20. Its earnings yield is $5 divided by $100, which is 5%. This 5% can be thought of as your initial rate of return on your investment if the company paid out all of its earnings to you as a dividend. It's the immediate yield your purchase price is generating. Now, let's see how drastically this is affected by the price you pay. Imagine that same company, still earning $5 per share. During a period of market euphoria, its stock gets bid up to $200 per share. The PE ratio is now a lofty 40. Your earnings yield, if you buy at this price, is now $5 divided by $200, which is a paltry 2.5%. You are getting half the earning power for your invested dollar compared to the investor who bought at $100. Conversely, imagine a market panic. The stock of this same company gets sold off down to $50 a share, giving it a PE of 10. If you have the discipline to buy at this price, your initial earnings yield is $5 divided by $50, which is a robust 10%. By controlling the price you pay, you can literally double or quadruple the initial earning power of your capital. This initial yield is the first engine of your total return. The higher your starting earnings yield, the less you have to rely on future growth to generate a good return. An investor who buys at a 10% earnings yield is already getting a bond-like return from the company's current profits, with any future growth being the icing on the cake. The investor who buys at a 2.5% earnings yield is almost entirely dependent on heroic future growth. Just to get a decent outcome, they are taking on far more risk for a lower probable return. This directly impacts portfolio growth and the ability to beat the S&P 500. A portfolio constructed with a weighted average earnings yield of, say, 8% or 9% has a massive, built-in tailwind. It is starting the race with a significant head start. A portfolio built by chasing popular stocks with earnings yields of 2% or 3% faces a powerful headwind and requires near-perfect execution from its underlying companies to succeed. Furthermore, this principle has a direct effect on capital gains. When you buy a wonderful company at a fair price, say at a 10% earnings yield, when similar companies trade at a 5% yield, you have two sources of potential profit. First, the business itself will continue to grow and generate more earnings. Second, the market may eventually re-rate the stock, recognizing its quality and bidding the price up to a level where its earnings yield falls to the 5% average. In this scenario, the stock price would have to double just to reach fair value, giving you a 100% capital gain on top of the earnings the business generated while you owned it. This is the double whammy effect that value investors seek. Overpaying for a stock not only saddles you with a low initial earnings yield, it exposes you to the risk of the opposite, a derating. If you buy a stock at a 2.5% earnings yield, a 40 PE, and the market sentiment sours, causing it to trade at a more normal 5% yield, a 20 PE, your stock will lose 50% of its value, even if the underlying business earnings haven't changed at all. This is how great companies become terrible stocks. The financial connection is clear and unavoidable. A high purchase price compresses your initial earnings yield, increases your reliance on future growth, and exposes you to the risk of multiple compression. A disciplined low purchase price provides a high initial earnings yield, creates a tailwind for your returns, and offers the potential for massive capital gains through multiple expansion. It is the single most important variable you can control in your entire investment process, the master lever that dictates the long-term trajectory of your financial freedom. The second pillar of our framework is perhaps Buffett's most famous contribution to the lexicon of investing. It is the practical application of our core thesis. The mechanism by which you ensure the price you pay provides not just a potential return, but a protected one. This is the principle of the margin of safety. The concept is, at its heart, an engineering principle. If you are building a bridge that needs to hold 10,000 pounds, you don't design it to hold exactly 10,000 pounds. You design it to hold 20,000 or 30,000 pounds. That buffer is your margin of safety. It accounts for unforeseen stresses, for errors in calculation, for the inevitable uncertainties of the real world. Buffett's genius was to apply this engineering concept to the world of finance. To him, an investment without a margin of safety was like a bridge built with no room for error, an accident waiting to happen. The quintessential story of the margin of safety in action took place long before Buffett was a household name, back in 1963. The company was American Express, a blue-chip institution known for its travelers' checks and credit cards, a wonderful business with a powerful global brand. But the company found itself at the center of a massive, embarrassing scandal. One of its subsidiaries, a warehousing division, had been duped in a spectacular fashion. A company called Allied Crude Vegetable Oil had taken out huge loans, using its inventory of salad oil as collateral. The loans were guaranteed by American Express warehouse receipts. The problem was, the salad oil didn't exist. The scam artists had filled their giant storage tanks, mostly with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied went bankrupt, and the banks came knocking on American Express's door, demanding to be made whole. Wall Street panicked. The headlines were screaming. Investors, terrified that American Express would be on the hook for massive, potentially company-ending liabilities, dumped the stock indiscriminately. The price was slashed in half, falling from over $60 a share to around $35. The herd was running for the exits. This is where Warren Buffett, the young, unknown fund manager from Omaha, saw not a crisis, but an opportunity. He didn't just look at the stock price, he did the work. He flew to New York and started his scuttlebutt research. He went to banks, to restaurants, to travel agencies. He talked to vendors and customers. He wanted to know one thing. Had the salad oil scandal damaged the core business of American Express? Were people tearing up their credit cards? Were merchants refusing to accept them? Were travelers shunning their iconic checks? The answer he found was a resounding no. The core business, the powerful moat around the payment and travel services, was completely unharmed. Customers still trusted the brand. The scandal was contained to a small, non-essential subsidiary. Having established that the wonderful business was still wonderful, he then turned to valuation. He calculated that even under a worst-case scenario, where American Express had to pay off every single fraudulent claim, the company's earning power would allow it to survive and thrive. He estimated the intrinsic value of the business to be, at a minimum, around $65 per share. The market, in its panic, was offering him this $65 business for just $35. That gap, that chasm between the price and the value, was his margin of safety. It was a bridge designed to hold 65,000 pounds, being offered at a price that assumed it could only hold 35,000. Buffett acted decisively. He made American Express the single largest investment in his partnership, allocating a staggering 40% of his fund's capital to the stock. It was a bet-the-farm moment, but it wasn't a gamble. It was a calculated investment based on a massive margin of safety. What happened next was textbook. The panic subsided. The company settled the claims for far less than the worst-case fears. The market realized that the core business was a money-printing machine. And the stock price soared. The investment was a home run, cementing Buffett's reputation and providing enormous returns for his partners. The salad oil scandal is the perfect illustration of the margin of safety, It's a principle that forces you to buy with such a large discount that it provides a double benefit. First, it provides downside protection. If Buffett had been slightly wrong in his analysis, if the liabilities were a little bigger than he thought, the huge discount at which he bought provided a cushion. The stock could have fallen even further from his purchase price, and he still would have been protected from a permanent loss of capital. Second, it provides massive upside potential. As soon as the market's fear dissipated and the price began to reflect the true value of the business, that gap between his purchase price and the intrinsic value became his profit. The margin of safety is not just a defensive tool, it is the most powerful engine for generating extraordinary capital gains. It is the discipline of waiting for the market to offer you $1 for 50 cents, a strategy that both protects you from error and guarantees your success when you are right. The market's visceral, panicked reaction to the American Express salad oil scandal is a masterclass in the psychological biases that the margin of safety is designed to counteract. The primary drivers of the market's folly were two of the most powerful and destructive forces in behavioral finance: loss aversion and herd behavior. Loss aversion is the well-documented principle, first identified by psychologists Daniel Kahneman and Amos Tversky, that for human beings, the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels far worse than finding $100 feels good. On Wall Street, this translates into a visceral, gut-wrenching fear when a stock starts to fall. As headlines about the scandal broke, American Express shareholders were not rationally calculating potential liabilities. They were experiencing the acute psychological pain of watching their portfolio value decline. This intense pain triggers a primal fight-or-flight response. The instinct is to sell, to make the pain stop, to get out at any price, just to staunch the bleeding. This is not a logical process. It is a deeply emotional one. The fear of future loss becomes so overwhelming that it eclipses any long-term assessment of the company's value. Buffett's temperament is the antithesis of this. He has trained himself to view falling stock prices not as a source of pain, but as a source of opportunity. He sees the market's emotional reaction as a signal to get interested, not to get scared. He replaces the feeling of fear with a feeling of curiosity, a mindset that is almost superhumanly rare in the investment world. When individual loss aversion is amplified across thousands or millions of investors, it creates the perfect conditions for the second bias, herd behavior. Human beings are social creatures. For millennia, our survival depended on sticking with the tribe. This instinct is still deeply wired into our brains. When we see others running, our first instinct is not to ask why, it's to run with them. In the stock market, this manifests as a powerful cascade of selling. A few investors, driven by loss aversion, start to sell. This puts pressure on the stock price, which triggers the loss aversion in another wave of investors who also sell. Soon, the reason for selling is no longer based on any fundamental analysis of American Express's liabilities. The reason for selling is simply because everyone else is selling. The falling stock price becomes its own justification for further selling. It's a feedback loop of fear. People look to the actions of the crowd as a source of information, assuming that the market must know something they don't. In the case of the salad oil scandal, the herd was convinced that American Express was doomed. The collective wisdom of the crowd became a collective madness. Buffett's genius was his ability to completely insulate himself from the herd. He possesses what he calls an inner scorecard. His judgment of his own success is based on his own research and his own analysis, not on the approval or disapproval of the crowd. While the herd was stampeding for the exit, he was calmly standing apart, doing his homework, and recognizing that the crowd's panic was the very thing creating the investment opportunity. The margin of safety, therefore, is as much a psychological tool as it is a financial one. It is a pre-commitment to only act when the irrational emotions of others create a clear, quantifiable, and significant gap between price and value. It's a system that forces you to be greedy when others are fearful, and fearful when others are greedy. It exploits the hardwired, predictable, and ultimately self-destructive emotional responses of the average market participant. By demanding a margin of safety, you are not just buying a stock cheaply, you are building a fortress around your portfolio that is designed to withstand the psychological storms of the market and to capitalize on the wreckage left in their wake. It is the ultimate triumph of reason over instinct, of independent thought over herd mentality. To operationalize the principle of the margin of safety, we need to move beyond theory and adopt a practical mental model. This is the business analyst, not market analyst approach. It is a systematic process for determining intrinsic value and patiently waiting for the market to offer you a price far below it. This framework will protect you from market sentiment and anchor your decisions in business reality. The first step is to calculate a conservative estimate of intrinsic value. The most intellectually honest way to do this is through a discounted cash flow, or DCF, model. Now, this can sound intimidating, but the concept is very simple. You're trying to answer the question, if I owned this entire business, how much cash could I take out of it over its remaining life? To do this, you start by estimating the owner earnings or free cash flow the business will generate over the next 10 years. You must be brutally conservative here. Look at the company's past performance, but don't assume the good times will last forever. Consider the competition, the industry trends, and the potential for disruption. It's better to be vaguely right than precisely wrong. Once you have a conservative projection of cash flows for the next decade, you have to estimate what the business might be worth at the end of that period, its terminal value. A simple way is to assume the company gets sold for a conservative multiple of its 10th-year earnings, say 10 to 15 times. You then add up all those projected cash flows, including the terminal value. But $1 in 10 years is not worth the same as $1 today. So you must discount all of those future cash flows back to the present using a discount rate. This rate should be the minimum annual return you would be happy to accept from an investment, for instance, 10%. This entire exercise forces you to think like a long-term business owner, focused on the cash-generating power of the enterprise, not on the squiggles of a stock chart. The final number you get is your estimate of intrinsic value per share. The second step is to set your discount rate and demand your margin of safety. Your calculated intrinsic value is not your buy price. It is the fair value of the business. You must now insist on buying it at a significant discount to that value. This is your margin of safety. A common rule of thumb, advocated by Ben Graham himself, is to demand a discount of at least 1/3, meaning you would only buy if the stock price was 66% of your calculated intrinsic value. For even greater protection, many investors insist on a 50% margin of safety. This means if you calculate a company's intrinsic value to be $100 per share, your buy price is $50. You do not budge from this. This non-negotiable discount is your protection against a litany of potential problems. Your own valuation errors, a downturn in the economy, a new competitor, or a management misstep. It is the shock absorber for your portfolio. If the business stumbles a bit after you buy it, your massive discount provides a buffer against a permanent loss of capital. The third step, and the one that requires the most discipline, is to wait for the fat pitch. The legendary baseball player Ted Williams famously said that the key to his success was not swinging at every pitch. He divided the strike zone into 77 baseballs and figured out he would only swing at the pitches in his sweet spot, where he had the highest probability of getting a hit. Investing is the same. You don't have to swing at everything. In fact, there are no called strikes in investing. You can stand at the plate forever and wait for the perfect pitch. After you've done your valuation and set your margin of safety price, you will find that 99% of the time, the market is not offering you a fat pitch. The price is too high. Your job is to do nothing. Patience is not passive. It is an active discipline. You put your target on a list and you wait. You continue to monitor the business, reading its quarterly reports, but you ignore the daily noise of the market. You are waiting for Mr. Market, in a moment of panic or pessimism, to serve up that one perfect, slow, hittable pitch right in your sweet spot. This is what Buffett did with American Express. The salad oil scandal was the fat pitch. The 2008 financial crisis was a whole inning of fat pitches. This approach fundamentally changes your relationship with market volatility. For the average investor, volatility is a source of fear. For the value investor armed with a margin of safety, volatility is the source of opportunity. You welcome market downturns because they are the mechanism that delivers wonderful businesses to you at ridiculously cheap prices. This mental model liberates you from the need to have an opinion on the economy or the direction of the market. Your focus is singular. Know what a business is worth, and don't buy it for more than half that price. It is the ultimate strategy for smart investing, and the only reliable way to achieve superior portfolio growth over the long term. To understand the genius of demanding a margin of safety, we must examine the tragic alternative, the all-too-common fallacy of catching a falling knife. This is what the undisciplined investor does when they see a stock price go down. They buy it simply because it is cheaper than it was last week or last month, without doing the rigorous work of determining if the price is below the business's intrinsic value. They mistake a cheap price for a good value, and in doing so they often grab hold of a business that is in terminal decline, getting sliced up on the way down. The perfect heartbreaking example of this is the slow-motion collapse of Sears. For decades, Sears was an American icon, a titan of retail. It was the Amazon of its day. But by the late 20th and early 21st centuries, the world had changed. Nimbler competitors like Walmart and Target offered better prices and a better shopping experience. The rise of e-commerce, led by Amazon, made Sears' massive network of mall-based stores a liability, not an asset. The company's fundamentals began to erode. Sales declined year after year. Profits turned into losses. The moat that had once been so formidable was completely drained. Now, here is where the path of the 99% leads to ruin. As the business deteriorated, the stock price began a long, painful slide. In 2007, Sears stock traded for over $130 per share. By 2012, it was down to around $50. An investor looking at this chart might think, wow, Sears is on sale. It's 60% off its highs. It's a classic American brand. It has to come back. This is the catching a falling knife mindset. The investor is anchored to the old, higher price and perceives the current price as a bargain. They are buying based on the stock chart, not the business reality. They buy at $50 feeling clever, but the business continued to get worse. The intrinsic value of Sears wasn't stable. It was a melting ice cube. The value of its brand was evaporating. The value of its real estate was declining as malls died. The company was burning through cash. So the stock kept falling. By 2015, it was under $20. Now, another wave of bargain hunters comes in, thinking, it can't possibly go any lower. They buy. But the ice cube keeps melting. The stock falls to $10, then to $5, then to under $1, and finally into bankruptcy, wiping out the shareholders completely. The fatal mistake made by these investors was that they never established a margin of safety. They saw a falling price but failed to realize that the underlying intrinsic value was falling even faster. There was never a point where the price dropped significantly below a conservative estimate of the business's worth. It was a classic value trap. It looked cheap, but it was cheap for a very good reason. A value investor applying the margin of safety framework would have analyzed Sears and quickly come to the conclusion that its competitive position was destroyed. They would have seen the declining cash flows and recognized that projecting future earnings was nearly impossible. Their calculation of intrinsic value would have been very low and likely declining each year. They would have seen that even as the stock price fell, it never offered a sufficient discount to that pessimistic but realistic valuation. They would have simply stayed away. The difference between buying American Express in 1963 and buying Sears in 2012 is the difference between investing and speculating. Buffett bought a temporary problem in a wonderful business. The Sears investors bought a permanent problem in a deteriorating business. The first investor was protected by a massive margin of safety. The second group was exposed to the full, brutal force of a business in terminal decline. This is why the work of valuation is so critical. It's not enough for a stock to be cheap. It must be cheap in relation to its true, durable, underlying worth. Without that anchor of intrinsic value, an investor is lost at sea, grabbing at any piece of driftwood that floats by, mistaking the wreckage of a sinking ship for a life raft. The direct financial connection of the margin of safety is its profound and dual impact on your wealth. It is simultaneously a shield that protects your capital and a coiled spring that generates explosive capital gains. Let's quantify this dual benefit. First, consider the shield, its power of downside protection. Imagine you analyze a solid, stable company and calculate its intrinsic value to be $100 per share. You adhere to a strict 50% margin of safety, meaning you will not buy the stock for more than $50 per share. You wait patiently, and eventually, a market downturn allows you to buy at your price. Now let's say your analysis was flawed, you were too optimistic. A new competitor emerges, and the company's true, long-term intrinsic value is actually only $70 per share, not $100. An investor who bought at what they thought was a fair price of $90 or $100 is now sitting on a significant loss. They have suffered a permanent impairment of capital. But you, because you insisted on a massive margin of safety, are still in a winning position. You paid $50 for a business that is actually worth $70. You are still sitting on a 40% unrealized gain. Your margin of safety absorbed the full impact of your analytical error and still left you with a profit. This is the ultimate defense. It's an admission that the future is uncertain and that you will be wrong. By building in this buffer, you create a portfolio that is resilient and anti-fragile, one that can withstand the inevitable mistakes and surprises that come with investing. Now consider the second benefit, the coiled spring of upside potential. Let's go back to our example. You buy the stock at $50, believing its true value is $100. This time, let's assume your analysis is correct. As the market panic subsides and investors once again recognize the quality of the business, they begin to bid the price up. The stock price eventually rises from your purchase price of $50 to its intrinsic value of $100. Simply by the price returning to a conservative estimate of fair value, you have achieved a 100% return on your investment. The margin of safety is the very source of your profit. The wider the gap between the price you pay and the value you get, the greater your potential for capital gains. This is how value investors aim to beat the S&P 500 over time. They are not trying to predict short-term market movements. They are systematically buying assets for 50 cents on the dollar and waiting for the market to reprice them at $1. This process has a powerful effect on your asset allocation strategy. When you can find these opportunities, you can invest with much greater confidence and conviction. This is why Buffett was willing to put 40% of his fund into American Express. His margin of safety was so large that the risk of permanent loss was minuscule, while the potential for extraordinary returns was enormous. It allowed him to make a concentrated, high-impact bet that dramatically accelerated his portfolio growth. Without a margin of safety, portfolio management becomes a game of timid diversification, spreading your capital thinly across many assets in the hope that a few winners will offset the losers. With a margin of safety, it becomes a game of targeted capital deployment, concentrating your funds in the few, rare opportunities where the odds of success are overwhelmingly in your favor. In essence, the margin of safety financially engineers your success. It preloads your portfolio with downside protection and upside potential, a combination that is the holy grail of sophisticated wealth management and the surest path to long-term financial freedom. Our third pillar addresses a crucial prerequisite for everything we've discussed. You cannot accurately value a business, and therefore cannot establish a margin of safety, if you do not fundamentally understand the business itself. This brings us to the principle of the circle of competence. Simply put, this is the idea that every investor has a limited area of expertise. Your greatest advantage is not in trying to be a jack of all trades, but in having the self-awareness to know the precise boundaries of your knowledge, and a resolute discipline to never, ever stray beyond them. Knowing what you don't know is your most powerful weapon against overpaying. There is no more dramatic or profitable example of this principle in action than Warren Buffett's conduct during the very dot-com bubble that destroyed so many others. Throughout the late 1990s, as technology stocks soared to unimaginable heights, Buffett and Berkshire Hathaway became objects of ridicule. They were completely absent from the party. Berkshire owned stodgy, old economy businesses like Coca-Cola, Gillette, and insurance companies. It owned no high-flying tech darlings like Cisco, Intel, or the plethora of new internet startups. Financial commentators and media pundits openly mocked Buffett. They called him a dinosaur, a relic from a bygone era who didn't get it. They said his value investing principles were dead, made obsolete by the new digital world. The pressure on him to capitulate, to join the frenzy, was immense. His own shareholders questioned his judgment. Barron's, a leading financial magazine, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article questioned whether the world's greatest investor had lost his touch. Through all of this, Buffett remained completely unfazed. His response was simple, consistent, and profound. He openly admitted, quote, "I don't understand these businesses." He explained that he had no idea how to predict which technology companies would be the long-term winners. He couldn't confidently project their cash flows 10 or 20 years into the future. He couldn't look at a company like Pets.com and determine, with any degree of certainty, what its durable competitive advantage was, or if it even had one. Because he couldn't understand them, he couldn't value them. And because he couldn't value them, he couldn't possibly know if their soaring stock prices represented a fair deal or a reckless gamble. So he did nothing. He stayed firmly within his circle of competence. He knew how to analyze a company like Coca-Cola. He could understand its global brand, its distribution network, and the simple, enduring appeal of its product. He could project, with a reasonable degree of confidence, that people would still be drinking Coke in 10 or 20 years. He could value that business and wait for a chance to buy it at a sensible price. He could not do the same for a company that sold microprocessors or fiber optic cables. His decision to abstain was not born of ignorance, but of a higher form of knowledge, the knowledge of his own limitations. When the bubble burst in 2000, Buffett's folly was revealed to be profound wisdom. While the tech-heavy Nasdaq index lost nearly 80% of its value, wiping out trillions of dollars of speculative wealth, Berkshire Hathaway's portfolio of boring businesses held up remarkably well. The dinosaur had outlasted the meteors. Buffett didn't need to predict the crash. He simply needed to avoid participating in the mania that preceded it. His circle of competence acted as a firewall, protecting his capital from the speculative flames that were consuming everyone else. The lesson is not that technology is a bad investment. In fact, Buffett has since made very successful investments in companies like Apple, but only after he felt he truly understood its business model as a consumer products company, not just a tech company. The lesson is that you have no business investing in anything you do not thoroughly understand. Your circle of competence might be in retail, or banking, or software, or real estate. Its size is not important. What is critically important is that you know exactly where the perimeter is, and that you have the intellectual honesty and discipline to stay inside it. Straying outside that circle, lured by the promise of easy money or the fear of missing out, is the fastest way to make a catastrophic valuation error and overpay for a business you have no right to own. The psychological trap that the circle of competence helps us avoid is one of the most insidious biases in human cognition, the Dunning-Kruger effect. This is a cognitive bias whereby people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. The Dunning-Kruger effect runs rampant in the stock market, especially during bull markets. When everything is going up, it's easy for a novice investor to mistake luck for skill. They might buy a few hot stocks based on a tip from a friend or a headline they saw on TV. The stocks go up, and the investor begins to believe they have a special talent for stock picking. They feel a surge of overconfidence. This overconfidence then leads them to believe that their newfound skill is transferable to any industry. Having made money on a social media stock, they suddenly feel qualified to pick the next winning biotech company, or to invest in a complex financial derivatives firm, or to speculate on the future of cryptocurrency. They have climbed to the peak of what Dunning-Kruger called Mount Stupid, a dangerous summit where confidence is at its maximum and competence is at its minimum. From this precarious peak, they feel empowered to make investment decisions in areas far outside their actual knowledge base. They are, in a word, unconscious incompetence. Warren Buffett's entire intellectual framework is a rebellion against the Dunning-Kruger effect. His insistence on staying within his circle of competence is a manifestation of radical self-awareness. He is a conscious competent. He knows what he knows, but more importantly, he knows what he doesn't know. His famous quote, "I'm not a genius, but I am smart in spots, and I stay around those spots," is the ultimate antidote to overconfidence. He resists the temptation to believe his success in one area, insurance, automatically qualifies him as an expert in another, semiconductors. This intellectual humility is his superpower. It prevents him from making the kind of catastrophic valuation errors that are inevitable when you're analyzing a business you don't truly understand. When an investor suffering from the Dunning-Kruger effect looks at a tech company, they see a story, a narrative of growth and disruption. When Buffett looks at a tech company, he asks questions he knows he cannot answer. What will the rate of technological change be in this industry? How long will this company's current products remain dominant? What will the capital requirements be to stay competitive over the next 20 years? His inability to answer these questions with any confidence is the signal that tells him he is outside his circle. The overconfident amateur, on the other hand, doesn't even know these are the right questions to ask. They simply see a rising stock and assume the good times will continue indefinitely. The Dunning-Kruger effect creates a fatal blind spot. It makes investors feel smart while they are behaving foolishly. By strictly defining your circle of competence, you are building a system that protects you from your own potential for self-deception. You are acknowledging that you are not a genius in all things, and that your path to wealth is not through brilliant insights in a dozen different fields, but through the patient application of simple, sound principles within one or two fields that you know inside and out. It is the triumph of self-awareness over ego, a psychological discipline that is far more important than raw intelligence in the pursuit of a successful investment career. So how do we practically define and operate within our own circle of competence? The key is to create a clear, honest, and disciplined mental model for self-assessment. This is the defining and expanding your circle blueprint, a three-step process to ensure you're always playing in your own ballpark. The first step is the three-bucket test. Take out a piece of paper or open a document and create 3 columns. The first column is labeled, "I am an expert in." The second is, "I know something about." The third is, "I know nothing about." Now, be brutally, ruthlessly honest with yourself. To qualify for the first bucket, you need to have deep, professional-level knowledge. This is likely related to your career or a lifelong, passionate hobby. If you're a software engineer, enterprise software companies might go in this bucket. If you're a doctor, perhaps certain healthcare or pharmaceutical companies. If you've run a retail business for 20 years, consumer goods and retail operations would fit here. The second bucket is for industries you have a good working knowledge of, but are not an expert in. You understand the basics, but you don't know the intricate details. The third bucket is for everything else. For most of us, this will be the largest bucket, containing things like biotechnology, mineral exploration, or complex financial instruments. Your investing universe, the only place you are allowed to hunt for individual stocks, is the first bucket and only the first bucket. The second bucket is your learning zone, and the third bucket is a permanent no-fly zone. This simple act of categorization brings immense clarity and discipline to your investment process. The second step is the explain it to a child filter. Before you ever invest a single dollar in a company, you must be able to pass this test. You must be able to sit down and explain to an intelligent 10-year-old in simple language exactly how this business makes money, what its product or service is, and why its customers choose it over its competitors. If you find yourself using jargon, complex acronyms, or vague phrases like "they leverage synergistic platforms to optimize user engagement," you have failed the test. This means you don't understand the business at its fundamental level. A truly great business, and one that is within your circle of competence, should be explainable in simple terms. You should be able to say, "This company, C's Candies, makes delicious chocolates that people love to give as gifts on holidays, and people trust the name so much they're willing to pay a little extra for it." If you can't achieve that level of simplicity and clarity, it's a giant red flag that the business is outside your circle. The third step is conscious expansion. Your circle of competence is not static. You can and should work to expand it over time. However, this expansion must be deliberate and knowledge-based, not portfolio-based. You don't expand your circle by buying a stock in a new industry and hoping for the best. You expand your circle through dedicated study. Let's say you want to understand the railroad industry. You should spend the next year, yes, an entire year, reading everything you can about it before you even consider an investment. Read the annual reports of the top 4 or 5 railroad companies. Read industry trade journals. Read books on the history of railroads. Understand their economics, their competitive landscape, their regulatory environment. After a year of intense study, you might be able to move that industry from your "I know nothing about" bucket to your "I know something about" bucket. After another year or two, you might finally be ready to call it an area of expertise. This slow, deliberate process of expanding your knowledge first and your portfolio second is how professionals grow. Amateurs do the opposite. They buy the stock first and then try to figure out what they own later, usually after the price has gone down. This 3-step blueprint, categorizing your knowledge, simplifying your understanding, and consciously expanding your expertise, is the practical guide to implementing Buffett's powerful principle. It ensures that when you do make an investment decision, you are operating from a position of deep knowledge, which is the only reliable foundation for performing an accurate valuation and avoiding the costly mistake of overpaying. The emotional force that constantly tempts us to stray beyond our circle of competence is one of the most powerful in the human psyche: FOMO, the fear of missing out. This is the antithesis of disciplined, knowledge-based investing. It is a purely emotional reaction, a social anxiety that has been weaponized by financial markets to lure the 99% into making disastrous decisions. FOMO is the voice in your head that whispers when you see a stock on the news that has doubled in the last month. It's the anxiety you feel when your coworker brags about the killing they're making in a new cryptocurrency. It's the nagging feeling that everyone else is on a rocket ship to riches, and you're stuck on the launch pad. This emotion is a direct assault on the circle of competence. It doesn't care what you know, it only cares what you're missing. It urges you to act now, to buy first and ask questions later, lest the opportunity vanishes forever. This is the path of pure speculation, not investing. An investor buys a piece of a business based on a conservative estimate of its future earning power. A speculator, driven by FOMO, buys a stock purely because its price is going up, hoping to sell it to someone else at an even higher price later. The speculator has no idea how to value the asset. Their only analysis is that the price is moving in the right direction and that the crowd seems to agree. They are not participating in a process of capital allocation. They are participating in a game of psychological musical chairs, hoping they're not the one left standing when the music stops. The dot-com bubble was a nationwide epidemic of FOMO. People who had never owned a stock before were suddenly quitting their jobs to become day traders. They weren't buying businesses. They were buying ticker symbols with .com at the end. They had no circle of competence in internet technology, but they had a deep and terrifying fear of being left behind. They saw their neighbors, their friends, their family members getting rich, and the social pressure to join in became unbearable. They abandoned all discipline and dove headfirst into a market they did not understand. When the bubble burst, they were left with nothing but a portfolio full of worthless stocks and the bitter realization that they had been the greater fool all along. FOMO is so dangerous because it short-circuits our rational brain. It triggers the same primal parts of our mind that are activated by social exclusion. The pain of being left out of the group can feel so intense that it overrides all logical thought. It makes you feel that the biggest risk is inaction, when in reality, in a FOMO-driven market, the biggest risk is participation. The discipline of staying within your circle of competence is your shield against this destructive emotion. It is a pre-commitment to a rational process. When you feel the pull of FOMO, you can return to your 3 buckets and ask yourself, do I have expert-level knowledge in this area? The answer, in 99% of cases, will be a clear and resounding no. This act of self-interrogation breaks the emotional spell. It reminds you that you are an investor, not a gambler. It reminds you that your goal is not to catch every trend, but to make a few, sound, well-understood investments over a lifetime. It is the boring, unexciting, but ultimately profitable path of the professional. The 99% chase the hot dot. The 1% waits patiently within the circle. The direct financial connection between staying inside your circle of competence and avoiding overpayment is rooted in the reliability of your inputs. A valuation model, no matter how sophisticated, is nothing more than a structured way of thinking about the future. The output of that model is entirely dependent on the quality of the assumptions you put into it. This is the classic computer science principle of garbage in, garbage out. When you operate within your circle of competence, you have a high degree of confidence in your assumptions. If you've studied the soft drink industry for years, you can make a reasonably educated guess about Coca-Cola's future revenue growth, its profit margins, and the amount of capital it will need to reinvest in its business. Your inputs are based on a deep understanding of the company's competitive position and the industry's dynamics. You can look at the balance sheet and understand what you're seeing. You can analyze the debt-to-equity ratio and know what is a reasonable level for that specific industry. You can assess the return on equity and judge whether it's sustainable. Your valuation, therefore, is anchored in reality. The intrinsic value you calculate is a meaningful number, a reliable guidepost for your investment decisions. Now consider what happens when you stray outside your circle. Let's say you, a retail expert, decide to invest in a biotechnology company that is developing a new cancer drug. You try to build a valuation model. What assumptions will you use for revenue growth? It could be 0 if the drug fails its clinical trials, or it could be billions of dollars if it succeeds. How do you possibly predict that without a PhD in molecular biology? What are the expected profit margins? You have no idea. How much capital will be required for further research and development? It's a black box to you. You are essentially guessing. Your inputs are no longer educated assumptions. They are wild stabs in the dark. The intrinsic value number that your spreadsheet spits out is meaningless. It is garbage, a product of fabricated inputs. An investor in this position, devoid of any real analytical anchor, becomes susceptible to paying any price. Their decision to buy is no longer based on a conservative valuation, but on a hopeful narrative, a compelling story told by the company's management or a TV analyst. They might pay a price that assumes the drug will be a blockbuster success, without any real way to assess the probability of that outcome. They are flying blind, using financial instruments without knowing how to read them. This is how bubbles are formed. A group of investors, all operating outside their circle of competence, trade shares of a company back and forth, basing their decisions not on the underlying financials, but on their shared belief in a story. The price becomes completely detached from the balance sheet, from the income statement, and from any rational assessment of future cash flows. Staying within your circle of competence ensures a direct and robust connection to the financial realities of the business. It means you are qualified to translate the qualitative aspects of the business, its brand, its management, its competitive position, into the quantitative language of finance. It allows you to produce a valuation that is an honest reflection of the business's economic prospects, giving you a reliable tool to prevent you from ever overpaying for a story.